Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking with Aaron Lee Kong of Carlyle. Aaron is head of direct lending and CEO of the BDCs group at Carlyle. Previously, he was executive chair of Organics Recycling. Before that, he was a member of the External Investment Committee of the New York State Common Retirement Fund and a managing director of Highbridge Principal Strategies, KKR, and Citigroup. He earned his bachelor's at UMass Amherst. So, Aaron, thank you for being on the podcast today.
Thank you for having me. Happy New Year.
Oh, thank you. Happy New Year to you, and Happy New Year to everybody on the podcast. We've had a couple of weeks to get back working 5 days a week and thinking about it. So I would like to start off with something that was exceptionally prominent in all investment managers' outlooks at the beginning of this year, which is how have higher rates, the market volatility, higher inflation impacted the companies that you've lent to. Are they managing it, not managing it? What is the status of all of those macroeconomic pressures on them?
It's a great question. So first, just to level set. So what we do, we're direct lenders. So the practice of providing loans generally to corporates in the US and Europe. By definition, my ultimate product for my investors is a non-volatile cash flow stream that's created by a very diversified pool of loans. To get that non-volatile cash flow stream, I generally, at the point of lending, I'm trying to find businesses that are non-cyclical, non-volatile, don't have a lot of technology risk. So to answer the question with that as the backdrop, I think direct lending and corporates are sort of a tale of two cities.
Mm-hmm.
If you are looking at companies who were provided loans prior to 2021, base rates were zero.
Yep.
The world was very different. I think in those cases, in all cases today, from just a revenue and EBITDA standpoint, as of the last quarter, I think on average, our revenue with all of Carlyle Direct Lending's companies were up around 12, 13% year on year.
Oh,
And
year.
EBITDA
Okay.
was up just over that. So you were finally,
Wow.
this is the first time since COVID that we've actually started to see operating leverage come back, which goes to your point of, how are they dealing with inflationary pressures? We've now gotten to the point of inflection where, for at least our portfolio, which is well over 160 positions, those borrowers are now able to efficiently, on average, pass on those inflationary pressures.
Right.
Which part of that is us lending to the right sort of names. Part of that is, if you lend to the right names over time, they can adjust their business models. Your other question, which is, I think, going to be a very important question this year, is interest rates. So over the last 24 months, base rates have gone from basically zero to SOFR last year, peaked at somewhere around 5.5, 5.4, 5.5%. That goes back to the tale of two cities part. Companies who were lent to when base rates were zero created capital structures that did not envision base rates going to 5.5.
Right.
So for those companies, not just within Carlyle, but within all portfolios, cash flow is exceptionally tight. On average for Carlyle, we're still Carlyle Direct Lending. Our coverage ratios are still somewhere around 1.5 times, but by definition, older borrowers, tighter. Newer borrowers where we've actually lent less, so less levered to be able to deal with the higher base rates, actually have higher coverage ratios. So very long story short now, from what we're seeing, companies are now able to finally pass on inflationary pressures. They've actually been able to deal with rising interest rates fairly well. Newer companies better than older companies, but most by and large are still dealing with it. And the cherry on top of that is, depending on which bank you speak to, most pundits are projecting somewhere between a 50 and 100 basis point decrease in base rates over the next year. So if you think about the impact of that on most companies, those companies that are older that have the tightest coverage ratios, this next year is going to be an incredibly important year because they're passing on the inflationary pressures, and theoretically their interest burden will start to decrease.
Yeah, it's I mean, it's fascinating to me how it takes inflation a while to rattle around through the system. Um, but it sounds like you're also doing some of the risk mitigation, as you mentioned, by lending a little bit less to individual borrowers. When did you start sort of curtailing that a little bit?
Yeah. So the act of lending is sometimes in this world we try to make things more complicated than they are. Right. So when you're thinking about how do you what we do in direct lending, what we're doing, as I mentioned, is how do you create that non-volatile cash flow stream at the end where our investors can get that paid out quarterly, because our investors are pension plans.
Right.
They're pension plans. They're individuals who are saving for their retirement. So the responsibility is making sure, that that cash flow stream is there every quarter, so that they can manage not just their retirement, not just their wealth, but their kids' wealth and what they're passing on to generations.
Right.
So to do that, when you're thinking about going in, well, one, you by definition, at every point, you have to be saying how much leverage can a company uh, bear? What is the right amount of leverage? By the way, what's the right amount of leverage if, for lack of a better term, something goes bump in the night? If things go wrong, which is what you're talking about right
Yes.
now,
Yeah.
what does that look like if their cash flow, their EBITDA drops by 30%? So we are doing that math ahead of time and saying, let's think about the right leverage level historically. Let's think about what happens if things go badly. Let's also think about covenants and what documentation we have to protect our investors, so that, again, there's a term I use all the time: bad news doesn't age well. If something's going wrong, you don't want to find out about it when it's already gone wrong. You
Right.
want to be able to predict that long ahead of time. So the what we're doing up front is risk mitigation. It is thinking about leverage levels. It is considering the sectors. Are we interested in those sectors? How volatile are they? How cyclical are they? Let's think about, the covenants. Let's think about the documentation. All of that's going into it. And quite frankly, which goes to the beginning of your conversation, are we changing that process? We're keeping the discipline process, but every day, you have this podcast each week. Each day, each week, we're bringing in new data points, and we're saying, how does that impact the process? So the same filters of discipline and are going into it, but you have to at each point say, oh, this happened in this sector. This happened with this company. How is that going to impact our underwrite for this new opportunity?
Right. So you have to have the evolution and the discipline for
Absolutely.
sure. For sure. Well, I do want to talk about covenants in a second, but but I'd like to stay a little bit more macro for a second. As a so I formerly was a ratings analyst at Fitch Ratings, so I love covenants. But the but I am curious about something you made a reference to the banks earlier. Where you think the banks are after what is nigh on a year ago, some very swift and surprising pressure that came along. Is there still an impact from that? Or is it just going to be in the regulatory environment that changes?
So it's a great question. I think, because of your past life, pretty much all opportunity in the alt space at some point derives from regulatory changes that impact the capital markets.
Right.
Usually that means they impact the banks.
Right.
So direct lending, by its very nature, and by the way, tradable loans by their very nature, can be traced back to Basel One.
Yes. Right.
Changes
Exactly.
in the back. Okay, then the LSTA was
Uh-huh.
formed. The modern trade, the modern leveraged loan, the modern CLO. By the way, if you go back long and you go back to the global financial crisis, that's the next piece. Basel Two, Dodd Frank, all of that. Constraints on the banking system always create opportunity for alt to fill that void. And that opportunity is, on the one hand, an opportunity, on the other hand, a responsibility.
Oh, okay.
Because the reality is our capital markets, banks uh, provide a useful service. Without loans, without the money supply, companies can't expand. If banks are becoming constrained, if no one steps in, that has a definitive impact to our economy. So for So what we do, what direct lenders do, is stepping into that void to allow that growth. Just like Basel One, just like Basel Two, just like Dodd Frank, any constraints on the banks by definition is a instant impact, just like post SV Silicon Valley Bank
Yep.
Corp
Yep.
and Basel Three Endgame. Not just an instant impact, it's a lasting impact. So are we seeing, to be frank, the impact on mid-market loans isn't large. Why? Because banks, since affect mid-market loans is defined by 25 to $100 million EBITDA companies, so fairly large companies. Banks weren't really in that business of holding those loans on their balance sheets um, since for probably 15
I was
years.
gonna say since 2012ish.
Yeah,
Yeah. Since
exactly
yeah.
right.
Yeah.
Where have we seen the biggest impact post last March, April, Silicon Valley Bank Corp and Basel III Endgame? We've seen the biggest impact in the upper market,
Okay.
where underwriting and taking underwriting risk of large market loans has become constrained. We're seeing the biggest impact in things like asset-backed loans. So all the loans that banks still were holding on their balance sheets, there is further pressures, and I think that pressure will continue to be. And quite frankly, the very interesting thing as an opportunity for us as well as our investors is in the past you've seen banks just pull back. Now you're seeing banks pull back, but also reach out for help from alt firms and direct lenders and say, can we do this together? So there's
Oh,
a
okay.
lot more partnership conversations happening today where banks are in our offices or we're in their offices and we're trying to think jointly how to solve these problems, which is great for investors, but also great for the capital markets.
Yeah, 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 for sure. Well, let's zero in a little bit on some of the recent transactions that have been going around because I see there's some published research that shows that equity has been about 50% of some of the more recent deals. Do you think that equity cushion is likely to keep going, or do you think that once again, if there's a decline, as has been predicted in interest rates, do you think it might slide a little bit?
So your questions are tying together. So the conversation on interest coverage and levels of leverage is the other side of the coin to the equity
Right.
conversation. Um, I think in the last year, the average leverage level for any transactions we've done is about 5 turns.
Okay.
The average that compares to historically north of 6 turns. The average LTV, loan to value, last year was under 40% for us.
Okay.
So more than 60% equity
Yeah.
on average. That has been a necessary underwriting point in order to manage risk for us and for the companies to be able to have the requisite interest coverage. You've had to take the leverage down and
Oh
you've
yeah.
had to have more equity
Okay.
in the transactions. To your point, to the extent that interest rates drop significantly and risk comes back in the system, yes, certainly it's not something that we're looking forward to and is not something that we'd be happy about. But I think over the course of a cycle, which is what we're describing, as interest rates go down, generally speaking, equity cushions do go down, can go down as well. For us, historically, we've underwritten deals at about 44% LTV. So usually about 56% equity in our transactions. So again, last year, more equity cushion. At the beginning of the year, I think our average was 35%
Oh,
LTV.
okay. That was a
Uh,
quick change then.
so it's gone from
Yeah.
35, yeah, 44 historically to 35.
Yeah.
And for the whole year, it's probably 37, 38.
Okay.
So to your point, as interest rates decline, you could see equity cushions move back. But I'd say for us, we're because of how conservative we are, that move back is probably still well north of 50% equity cushions. But
Okay.
at the
Okay.
larger part of the market, I think you're absolutely right.
Okay. Okay. Interesting. Well, let's get on to structural changes in covenants now because covenants
Your
have changed
favorite.
a lot in the last decade. The one of the things that a lot of analysts were looking for were the percentage of cov light, and that seemed to change a lot as the structure of covenants changed. That what was cov light became a question of the eye of the beholder, and a lot of things were parked into other covenants. So, what are you seeing sort of from a longer run in the evolution of covenants, and where are we now?
So before I came up here, I was speaking to a colleague of mine about, I think I've been doing this for about 26 years. And so you've seen a few cycles, and part of your role, my role, if you're going to be a good investor and particularly someone good at managing risk, is ignoring the noise, is sticking to the discipline and saying, I know this time is different, but I still need my protections.
Right. It's never
It's
different.
it's a little different,
Yeah.
but not very. So, um, in direct lending, so there's multiple markets, but in mid-market direct lending, historically, Carlyle's has had probably somewhere in the upper 80s percentage of our book that has been had covenants. The percentage of our book that hasn't had covenants has actually been the small amount that's been junior, and we've
Yep.
effectively relied on the senior covenant.
Yep.
So historically we've been much more covenant focused. Last year, I think we may have done one transaction out of 60 to 70 transactions that didn't have a covenant.
Okay.
So we are exceptionally covenant and documentation focused. To your point, the BSL market is largely the broadly syndicated loan market is largely uncovenanted.
Right.
What has occurred is the large market in direct lending. So call that north of $200 million because that is a big change over the last 3 years. Historically, large companies went to the BSL market, and you didn't necessarily have the opportunity for very large companies to go to the direct lending market. Today, decent size of our market is made up of companies with well north of $200 million of EBITDA. It has become increasingly common for those companies to be cov light or to be cov wide. So the
Right.
covenant is struck usually a leverage covenant is struck so wide that it doesn't matter.
Right.
The argument for that, because the arguments are made, is this time if it's such a large company, there's less risk, and you're protected by the size, the scale, the diversity of corporation, et cetera. I think it's all of our responsibilities. We look at cov light deals. We are much more hesitant to do them, but though they are the larger part of the market, that is part of the market that's here to stay. And it's something that everyone is going to have to deal with. We historically have been much more cautious in that part of the market, though.
Oh, interesting. Are there other ways that the due diligence slash underwriting process has changed in addition to that?
So the direct lending market has become much more institutionalized. So 15 years ago, the direct lending market, the way my business and most businesses work, you have originators. It sounds like a commercial bank whose role is to go out there, find companies who actually need to borrow money that are appropriate for our risk metrics. You have our underwriters. Again, sounds like a bank
Yeah.
whose job is to run that through our modeling, do the diligence, kick the tires to figure out exactly whether or not this actually is up to snuff historically.
Right.
They, as well as all of the rest of Carlisle, which we have a very broad, we have thousands of people who at any given time can be helping structure, diligence, and negotiate these transactions, then form the loan. Today, so 15 years ago, finding those loans was very hard work
Mhm.
because again, you were waiting for banks to pull back. You were finding those corporations. A lot of them were non-sponsors, so private equity sponsors didn't back them.
Right.
Today, if in 2007, I, along with a few colleagues, was starting, KKR's capital markets business. We were probably one of the first PE firms. I think TPG had one that actually had their own internal capital markets business. Today, effectively, it would be strange if you are a private equity firm above $5 billion of assets management not to have a capital markets business. So finding direct loans looks a lot more like a pseudo syndicated loan where PE firms are actively calling my originators. My originators are calling those capital markets businesses to figure out. So if you think about one of the biggest technology evolutions, it's been the institutionalization of the origination framework, because the loans are on the PE side much easier to source, though there are significant benefits to being Carlyle, for instance, and having our global platform and
Sure.
having all of our capital. You then also have, quite frankly, significantly built out the diligence framework. So, by definition, Carlyle today has been in this business for over a decade. That decade worth of diligence on companies. So you now have what you didn't have 15 years ago. There's companies that have been private and have been doing private issuance for a decade. There's companies that have gone from private to liquid. So your ability to actually source and create diligence in a place like Carlisle to manage risk is significantly higher than it would have been a decade ago. I think the liquid market, the reason why it's so interesting is historically you get so much better you get information.
Right.
The illiquid market now, because of how institutionalized it's become, and particularly at a place like Carlisle, you now actually have effectively a library of decade of information, both on the public side and the illiquid side, that allows you to be able to diligence sooner and better.
Yeah, that's the time series data that we're all told in CFA level one is king. Yeah, those stuff.
You got it.
Um, do you think that institutionalization creates any risks? I'm just thinking through. There's no free lunch out there, as they say. So, like every time I hear about a big change like that and formalization of something, I think, okay, is there a risk that all the investors are going to do one thing in it?
Great question. I think with maturation, evolution, institutionalization, all of that, um, all those words mean that the business is becoming more transparent. And transparency means, quite frankly, the business of direct lending, it's harder for me and my team
Sure.
because we now have to, and this is why Carlisle matters or I matter. We now have to bring a different perspective to create. You don't usually use this term in a private context to create alpha.
Right.
So
Right.
if what I just described is if every PE firm has a capital markets desk and is syndicating loans, and lots of folks can get a look at those loans, and lots of people can structure them, why Carlisle? So I have to spend a lot more of my time as the person responsible for the business trying to create an edge. I have to spend a lot more of my time, and that's the business of what all of us are in, saying, what are the other ways I can source? So at Carlisle, you have the private equity sourcing mechanism, but we also have to source from non-sponsor deals. So we source in Europe, not just in the US. We also source asset-backed lending. So figuring out the different ways to create a diversified sourcing mechanism so that when I'm putting together my portfolio of loans, I am creating that differentiation relative to everyone else. So the risk is, quite frankly, not a business risk. It is as you know, the equity market went through it, the high yield market. As things mature for an asset manager, it is our responsibility to provide differentiation. I'm the only, I think the only person that runs a business like this. That my last role, you mentioned, I ran organics. That
Right.
was a waste management business
Right.
that I left this business. I was at a waste management business that I bought, that I used direct lending capital and restructured it.
Okay.
So I'm showing up every day, having also borrowed direct lending. I'm also showing up every day. You mentioned I was on New York Pension Plans board. I'm showing up every day, having thought about it from the public pension investor standpoint. So the difficulty of this business is you have to show up with a different perspective in order to create that value for your investor. That is, with all the capital flowing into direct lending, there's going to be a large swath of the business that is a commodity.
Yep.
And by the way, commodities you get paid a different price for.
Yes, lower.
and there's going to be a large part of the business that, like what I think about every day, you're going to have to think about how do you differentiate that to say, here's why I'm not the commodity side of the business.
Yeah, fascinating. I mean, this is a transition that a lot of CFA New York members have gone through, whether they were in ETFs, private, public. It's all over the place. The need for evolution across everyone's career is present, and but you must be one of the rare few people who was a borrower at some point in their past.
My wife thought I was crazy. But yeah, no, I spent I went to KKR back in '07, and there were less than 100 executives there at that point,
Wow.
and we were thinking about all of we're starting a capital markets business. We just started a credit business. So part of my career has been where is what does Wayne Gretzky used to say? Skate to where the puck's going.
Yeah, right.
So where are we going? When I saw the business that I ended up buying, that was in many ways you spend time in PE, you spend time lending. That was the way to create true value for myself and my investors. By I know how to restructure this business, I know how to access capital. So that's why I did it. That was almost 5 years of my life restructuring and recapitalizing that business. But that's all of those. I was speaking to my colleague earlier. I think it's really important for all of us in our careers to have that diversification. No different than my portfolio. The sometimes society today is trying to force us all to do one thing,
Right.
but if you're only doing that one thing, you only have that one perspective, that's not going to help on all the risks. So the most valuable people, as AI comes to the forefront and can get that answer, you just being able to do math isn't going to differentiate you anymore. The people who work at Carlyle and all the best firms, having that differentiated perspective is going to allow you to, one, identify those risks a little bit sooner, because if you've all done the same thing, that's not going to help.
Right.
But it's also that differentiated perspective is going to allow you to point to where the opportunities are.
Right.
The reason I thought a waste business was interesting is, one, it was an ESG focused waste business.
Okay. Right.
And to be fair, I was sitting on a board of a pension and I realized we're putting so much money in ESG, and there aren't that many businesses that's all they're focused on.
Right.
And wow, this is one of those businesses. But then two, I realized from my time at my previous alt firm, one of our most amazing set your clock by businesses was a waste business that I
Right.
actually knew pretty well. So you
Right.
put those two. So I would encourage all of your listeners, the if you have to one thing to do in the next 10 years, it's do different.
Right. Right. Oh, that's a great place to leave it. Do different. So, Aaron, thank you for being here. And thank you to all of you who've listened to this podcast. I hope that this has been informative, but also motivational, because Aaron brought up some great things there. So we'll be back next week with another podcast. Until then, I'm your host, Rob Rowan, and this has been Compound Insights.